Again, I'm Lemon Senbet, Executive Director of the African Economic Research Consortium, called ARC. And also, I'm on leave from the University of Maryland. I'm a chaired professor of finance at the University of Maryland. So the topic of this panel is financial inclusion in Africa. And we have distinguished speakers. And they will be making initial remarks. And then I will follow up with questions. And then we will have question and answer session. So Peter Quarter is from University of Ghana. He is a professor in development economics. He is also a long-standing alumnus and resource person of ARC, a researcher of ARC, and he's published extensively in the area of finance. And then we have a distinguished governor of Central Bank of Rwanda, and he has a long history. So I don't have much time to go over this, but I just want to say that prior to being governor of Bank of Rwanda, he was also a minister of finance. And let me also then move to a partner. We have a development partner on the panel from USAID, Oren Waishe Shaw, and she is a deputy assistant administrator for the bureau, and then coordinator for President Obama's Trade Africa Initiative. And then Robin Lewis is a research analyst and associate fellow to the Center for Technology Innovation in the Governance Studies Program at the Brookings Institution. By the way, at some point, I'm going to make use of a couple of high-level policymakers in the audience to actually intervene in this topic. So I'll proceed. I'm going to ask Robin. Yeah, why don't you just stay with three minutes remarks? Okay, and there'll be no footnotes.
Well, thank you so much for the introduction and for having us all here today for the panel. My name is Robin Lewis. I am an associate fellow here at the Brookings Institution, and I thought I would just briefly provide a little bit of context on a financial inclusion project that we have here at Brookings, aptly named the Brookings Financial and Digital Inclusion Project. And the aim of this project is to assess country commitment to and progress toward financial inclusion across a diverse array of politically, economically, and geographically diverse countries around the world. And what we are hoping to do with this study, which we published in 2015 and then most recently in August of this year, is to provide policymakers and members of the general public, as well as NGOs and other entities involved in this space with information that might be useful to them as they seek to improve access to and usage of formal, affordable financial services for those who may be at the margins of the formal financial ecosystem or excluded from it completely. So that has been our objective with this study, and the topic today is a very salient one for us. We have worked extensively with policymakers and NGOs around our focus countries to solicit their input and feedback on what initiatives are most effective in advancing financial inclusion. So we are very grateful to be here and looking forward to hearing the other perspectives on the panel.
Oh, thank you for being so much on time. Governor, I'm going to turn this over to you.
Yeah, thank you. Thank you, and let me start by thanking Gideon for inviting us to be part of this discussion. I know there were questions at the beginning that we don't have policymakers on the panel, but I think we're always happy to be part of such discussions that feed into what we do. So such institutions are very key to supporting whatever we do as policymakers. So happy to be part of this discussion. Now, back on the topic of this panel on financial inclusion, and we are being asked what different stakeholders, which role can they play in promoting financial inclusion. And I think the starting point is to understand what is the issue. I don't know whether that's a part, maybe a research question as well. So what's the issue about financial inclusion or financial exclusion in actual sense? So it's really important that today financial inclusion has had big attraction from almost all international development agencies and governments and private sector. And the question is why this attraction towards financial inclusion? What does it mean? It's not financial inclusion for the sake of financial inclusion. It's because we are convinced that financial inclusion leads to inclusive growth and development. So how do we link one? How do we promote financial inclusion across the world? Because today, in the developed world, it's like a universal. We talk of, I think World Bank is giving us 94%, but those who are not, it's their choice. They just don't want to work with financial institutions. But in the developing world, sub-Saharan Africa, we are at just 34% of the population being financially included. I think the question then is why do we have this problem in sub-Saharan Africa? And I think we as different stakeholders can work together to, one, understand the problem, because for getting a proper solution to a problem is you need to understand the problem. So here, the researchers play a big role. We have researchers like, back home we use what we call Finiscope. Finiscope, we do a Finiscope every 4 years. They assess the level of financial inclusion within the country, and every 4 years we track how far we've gone. And we devise policies based on the outcomes of these surveys done by Finiscope. But we also have different other actors. I just want to use Rwanda as an example. We have government, of course, is taking a leading role as policymakers that are promoting development of the country in general. So financial inclusion is just one part of the big development agenda, and so we lead in different aspects on this. But we have NGOs involved, one in research or in trying to understand the problem, but also involved in mobilizing the population to understand the benefit of working with financial institutions and supporting them to link them to financial institutions. Then we have, of course, we work with the Access to Finance Forum. We have an Access to Finance Forum board in Rwanda, which is like a channel used by different development partners to support financial inclusion initiatives and other efforts across the country. So I know we are supposed to be brief, but I just want to say that we have to look at this at different levels. Understanding the problem, trying to get the solutions, and then the resources to address the problem. But part of the problem is, at least from our Finiscope in 2008, was one of the challenges of access to finance was access, in actual physical access, the distance between a financial institution and where these citizens were. Number two was, of course, awareness, understanding the benefits of using a financial institution. So part of the problem access, we've sort of resolved that with 2 ways. Government supported local communities to set up savings cooperatives, which you call SACCOs. And so today we have, every citizen has a financial institution within maximum 5 kilometers from where they stay. Technology is also helping to even break it further to shops, and shops are becoming like a banks, using what we call agent banking and then mobile technologies. Access is resolved. Now the issue is the knowledge and awareness and the financial education of the benefits of using financial institutions. But also us as regulators now are responsible for the trust, the stability, and the trust between the citizens and the financial institutions. So this is a wide topic that we can really discuss going on, but let me stop here and I'll be happy to come back to answer any other question.
Thank you, Governor. So let's go to Peter Quarter. Just brief remarks.
Well, thank you very much. Let me thank the GDN for inviting me here, the AERC, of course, and then Brookings Institution. It's nice to be back again with the AGI to meet our collaborators. In terms of financial inclusion, most African countries have what we term the dual economy. We have the formal economy, we have the informal economy. Similarly, we have formal financial system and informal financial systems. But it looks like the way we have defined or conceptualized financial inclusion is to look at the formal system. And therefore, by so doing, we try to exclude a lot of the informal sector activities. Believe it or not, informal sector activities account for over 70 to 80% of economic activity. So there is the need to take a closer look at the way we consider financial inclusion. Of late, we have the digital financial systems, so inclusion where we have mobile money, we have other forms of financial systems. The informal sector, they have their own way of accessing finance. They have their own way of accessing credit and the rest. So we need to take a second look at the way we conceptualize financial inclusion. Then the second point I want to raise is the issue of financial literacy. There are quite a number of people who are not literate financially. If they knew what a financial system could do, I'm sure they would access the financial services. For some, the idea of even having to walk to a bank or a financial institution to fill a form is so scary. It's quite an activity that puts them off. And I think we need to educate people how to invest their money, where to put it, what kinds of returns we are likely to get. And I think the financial literacy aspect is quite important. There has been, of course, some education, some financial literacy education, but we have not yet assessed the impact of some of this education. And I think it's about time we look at this. I will later on come and if I get opportunity, to talk more on some of the research, given my background in research, some of the areas I think we should focus in terms of financial literacy. Thank you.
Thank you very much. Michelle.
Yes. I'd like to first just respond to a comment or a question that was asked earlier in the first panel about diaspora and development policy. It's recognized, certainly within USAID, that we can't do it alone. Diaspora is actually extremely important, to the point that we will have a Diasporan Development Conference, global conference this month, later this month, and I was personally tasked by the administrator of aid to come up with a diaspora strategy for Africa. So we are, and to make it not just a shotgun approach, right? Not just a particular project, but to see how we can incorporate diaspora into the way in which we do development. So there is a recognition that those who are here, but not just here, who are in Canada, et cetera, can bring a lot, both in terms of their knowledge of the environment, right? As well as know-how and also finance. So that, I just wanted to throw that one out there. With respect to financial inclusion, I would agree with many of the points that were made here. I'd like to just sort of focus on a couple. Financial inclusion, I would argue, starts with macroeconomic management of the economy. That if in fact you do not have an economy where the rates are such that it makes sense for small, medium, micro entrepreneurs and individuals to borrow and also to save. I was in one country recently where we were talking about inclusion and access to credit and trying to encourage depositors, right, people to save. And yet it was a very simple calculation that I calculated quite quickly with the Minister of Finance sitting there, the Minister of Energy, the Minister of Agriculture, to say, based upon the way in which the rate structure was set, anyone saving is losing money. because based upon the interest rate for deposits versus the inflation rate, it made sense for people not to put money into the account. So the macroeconomics is sort of the overarching environment in which one can talk about availability and access to the financial institutions. And I'd be happy to talk more about that. Technology has been already mentioned, and I would dare say that we see, mobile money, some of these areas, as things that are indeed helping to broaden access. Africa certainly has overcome the rest of the world in terms of mobile money. So while the rest of the world on average is using about 2%, 2% of the population is using it, in Africa it's about 12%. And what that says to me is that instead of looking at what the technology has been, right, what the systems have been, that Africa has the opportunity, again, to leapfrog, to not build upon the systems that were, similarly to what they did with mobile phones, with cell phones, to not try to reinvent the landlines, but literally to leap over it. And in financial inclusion, I think there are opportunities to do that as well, and it has already started in Kenya, in Rwanda, but I think we need to look at it more broadly and from the policymakers' perspectives to also look in terms of what does that mean, taking a step back to say, if we want to encourage this new approach, then what is that going to mean in terms of policies and where the emphasis are? And I'd be happy to talk about that. Financial sector access. I know there's a focus on agriculture and rural. I would only say that, again, as policymakers and as researchers are looking at it, and indeed there has been a focus on agriculture and on the rural sector, services is becoming the fastest growing sector for many of the African economies. And so we should not exclude services. And many of those services actually help to complement agriculture production and productivity. And so to look at it much more broadly, as opposed to necessarily focusing on those two sectors. And then finally, and as a former banker who worked in emerging markets and developing economies, I would say that where's the private sector? Policy is not just sort of research and then policies are developed, but the interaction also with those for whom the policies are going to have an impact, and having that circular discussion about what is it going to take for us to do it and to make it work. So it is really the ongoing dialogue between research, policy, and those for whom the policies are going to apply. And I think I'll leave it at that.
Well, thank you very much. This is very informative. I had originally planned to ask different questions to different panelists here, so I'm going to adopt my predecessor's model. So I will have 3 areas, and then I'm going to ask each one of them to respond. So it will be on linking financial inclusion to the real world, in this case, inclusive growth, and the other is technology, and then the policy space. Since we don't have much time, but I'm going to end maybe in 15, 20 minutes. Coming to the whole arena of conversation about SDGs, inclusive growth, and in particular focusing on agriculture and focusing on 3 agents of inclusivity, meaning the small farmers, the youth, and women. I would like each one of you to respond as to how you can get those guys to be bankable and insurable. Let me begin with the development partner
With the development partner.
and banker.
Former banker.
Yeah.
Small farmers, youth, and women, and how to get greater inclusion. I know in terms of some of the things that we're working on right now, and basing it on agriculture, is really looking at the value chain, not just the production, but there's a whole value chain related to agriculture. There's storage, cold storage. There is transportation. There is processing. And then there's transportation across borders, so as to have a much larger market and reinforce regionalization, which is one of the tenets of the AU, right? As well as food security. So in terms of how one would get and increase the ability for these various populations, I think one has to look at it as value chain, right? I mean, a small farmer, you can get cooperatives, et cetera, but they're going to have to sell it to someone. There has to be a value chain that they can build into. Once that value chain is there, you have a buyer. And so the risk of selling the product becomes much less for the banker. Youth, and I will speak, he didn't talk about it, but I'm older than I look. Yeah. So when I was the vice president for TechnoServe for Africa, we worked in agriculture. And one of the things we found, 10 years ago, is that lifestyle expectations of the youth is changing. The fact that one could make and could work with farmers, small farmers, and increase the price they got for whether it was groundnuts or cocoa or whatever we were working with by 25% was not sufficient necessarily for the youth to stay on the farm, because their lifestyle expectation was that of their cousins who were in secondary cities, tertiary cities in the capital. It was a lifestyle issue. It was not just a cash issue. And so what we have found is getting them into jobs or helping them become entrepreneurs in that value chain, whether it was in transportation, becoming entrepreneurs to manage and own cold storage, but to do something other than. I think, and you guys could probably speak to this better than I, but I think I recall hearing something that the average smallholder farmer's age is rather high. And that is not because there is not demand. It is because lifestyle expectations are changing in the youth. So again, if you had that youth, or women, right, who were in the value chain of agriculture, not necessarily staying on the farm, and building the robustness of that value chain, it would help deal with the risk along the value chain.
Thank you. Governor, you can weigh in.
Thank you. Let me start with the farmers. I think the question is, why are they excluded from finance? I think in most cases when they talk of agriculture, thank you for the value chain aspect of financing agriculture. I think in most cases when you talk of financing agriculture, people focus on financing the primary production in the farmland. And financial institutions, most of them are not, let me not use the word willing, but they're not able to finance the farm because the risk is very high. And the risk is very high because there are many natural factors that most of our farmers like to. So I think the beginning is to de-risk agriculture if you are to promote financing for agriculture. So today, most of our farmers rely on nature to get water. If you have drought, you're going to have the entire agriculture failing. And therefore, if a financial institution put in money, you would expect what that means. Even the insurance sector that is supposed to cover these farmers against the natural disasters can't also determine the level of the risk they've been insuring. So one is, of course, a reliable climatic condition data will help insurance sector to know, to project the risk, and therefore be able to cover. So there's need to de-risk agriculture if financial institutions are coming to support these farmers, plus then linking them to the markets and also introducing modern techniques of farming. And so trying to modernize farming, really migrate from subsistence farming. But it's like a chicken and egg, and all this can be done when there's financing. But you wouldn't expect financing from financial institutions to deal with these issues. So I think on agriculture, that's what I think is key that we need to focus on. That's where donors come in. That's where government comes in to support these farmers, to invest in this infrastructure. On youth and women, I think the most important thing that we're trying to address, and which I'm sure it's a big problem even in other developing countries, is reliable data that segregates access to finance along those lines. At least we need to be sure to understand when you talk of financial exclusion or inclusion, what's happening with women, and that requires really segregated data. And then part of what the researchers could do is really to understand why do we have more women excluded than men.
Yeah.
So understand the problem. There's the perception that women are risk averse, and therefore they will think twice before they go to a financial institution to take a loan. But it's also positive the other way around. When they decide to take a loan, it's very rare that they will fail to pay back this loan, because when they enter into it, they are committed, and the non-performing loans on that side you expect to be very low. So how do we bridge this gap? Normally, they have good customers of financial institutions, but because of the risk averseness nature, they will be reluctant to access this financing. So there we need people to understand exactly how to focus on this issue. I think for youth, it's about mobilizing them into job creation initiative that can create small investments, and I think it's about organizing them and really helping them to do bankable projects, and that's how they can access more financing.
Thank you, Governor. That's very helpful. I think for the two of you, Rob and then Peter, on the same subject, I want you to talk about the impact of digitalization of finance or technology on the same agents of inclusivity of growth.
Right, okay. I think I share the points raised by the earlier speakers, the value chain issue. But then the digitization can be linked to what I would describe the forward contracts, where financial institutions will deal with farmers, small-scale farmers, where they will provide credit in advance of production, in advance of farming. Some studies have shown that has really helped in providing sustained finance for some of these companies or small firms. Then the issue of crop insurance is, for me, very key. Chris Udry of Yale University, together with my institution, have done quite some work in the northern part of Ghana. It has shown that providing crop insurance, where farmers are given some insurance packages in case the crop fails, there is some amount of money given, has really helped in ensuring small-scale farmers' production. Then also small-scale irrigation, I think that has been touched on well. Women, you see, the problem with women having or lacking access is the issue of collateral. In most African economies, when partners own an asset, most often it's registered in the name of the man. Is normally the tradition. So women do not have collateral to be able to access finance. And if we can try and bring this issue to fore, try to separate that process, I think that will help. Then lastly, youth save. And that is where the digitization might also come in quite well. The youth can, they often say, catch them young. Often at an early stage, you get them to open accounts, you get them to start operating bank accounts, and gradually you can get a youth to have access to credit. At ISA, at the institution where I work, we have a project called the Youth Save Project, together with MasterCard Foundation. And what we have done is to go to schools and get the youth to open accounts. The bank or the financial institution will come to the schools, open accounts, get the students to operate the accounts. So by the time they leave the respective institutions, they have cultivated that habit of saving, and that that process continues.
Yes, thank you, Peter. Rob.
And I should mention that our Financial and Digital Inclusion Project is housed within the Center for Technology Innovation in the Governance Studies program at Brookings. So this technology angle is one that's of great interest to us. So I'd like to follow up and connect two of the threads that I think have been previously discussed, the role of digital in financial inclusion and then this gender gap in financial inclusion. So we do know from the evidence that women tend to be very good savers, they're very reliable in repaying loans. That's not to say that women are all one monolithic block, but we know from the evidence that there are some behaviors within that segment that are very attractive or should be very attractive to financial service providers. And yet we also know that as of 2014, there was about a 9 percentage point gap between account ownership among men and women. So in thinking of some very pragmatic ways that we can leverage the digital mechanisms that are available to us to extend access to financial services for women, I think two examples that spring to mind as sort of low-hanging fruit are digitizing wage payments and also offering digital mechanisms, say mobile money accounts and other digital programs for paying school fees. So I think the central idea here is that if you provide women and any other customer segment with products and tools that have demonstrable utility for them, then you're likely to see increased adoption over time. On the mobile money piece, which is also of particular interest to us in sub-Saharan Africa especially, there is a remaining gap in terms of mobile account ownership among men and women. But we continue to see this really rapid proliferation of mobile technology that we think holds a lot of promise, not to the exclusion of other digital financial mechanisms, but it's one area that's very exciting to see in sub-Saharan Africa.
Thank you. I think this got me to think that we should pay attention to what I call consumer protection, right? And the whole arena of regulating digital financial services. And I want to do that because I have actually two countries here. Rwanda, is another success story. And then Kenya, as you know, has been a pioneer in terms of coming up with a homegrown innovation. In fact, I remember once I served on the Global Financial Task Force. I showed up at the inaugural meeting in Washington, D.C., and there were the two African representatives did not show up. I was the only one. And then half of the morning was about Kenya. So, former Governor Juguna is in the audience, and he was actually in the midst of Kenya becoming the frontier of financial inclusion. So basically, I wanted you to maybe weigh in as to how to regulate digital finance, especially when we have multiple providers. For instance, should it be regulated by utility companies or bankers, or could it be functional? So if you could actually do that, maybe 2-3 minutes, and I'm going to then turn this over to our governor, Rwanda.
Oh, thank you. Very hard question when I have already left my job,
Yes.
But anyway, I think you're right. One of the first starting point about financial inclusion is accessibility, because I know you talked about informal financial services, but essentially if you are looking for safety and soundness, then you do not go into the informal financial services. So there is always a distinction. But let me make 4 points before I get to your question. The first thing is we have to solve the problem of accessibility as well as barriers to entry, which are mutually reinforcing when you come to digital finance. Because the poor are very sensitive in terms of how they get financial services and the products that get to them. That is the delivery mechanism becomes very, very important. But what we have realized and what we have shown is that if you want to come up with a financial inclusion model that is also going to be very important in terms of sustainable poverty reduction, then digital financial services has shown that it is the most positive way. And secondly, we all are interested in terms of financial stability and financial development. Now, the first thing is to solve the transactions problem, because that's one of the major barriers to entry into the financial system is transactions cost. And that is how we really want to look at it as a platform. But because it's going to encourage or to attract so many people, then the next thing is how do you regulate that? But I'm going to touch on that. And finally, and third is that what we have seen, especially in Kenya and the East African region, Tanzania and Rwanda, is that digital financial services just opens possibilities and opportunities for a game-changing opportunities. You can start from everywhere in terms of transactions, in terms of providing credit, and in terms of even changing the framework of monetary policy. All these have come together in different stages of innovative development. And finally, to come back to the question, the broader question, inclusive finance can lead to inclusive growth. But the intermediary here is that you have the economy must be vibrant enough to provide a supply of investment opportunities. Because if you don't have that, then the savings that is accumulated by the poor will go only into consumption smoothing, and it's not invested. So it's actually something that we need to look at. Having said that, then what is the whole architecture of providing these financial services? And that is, how do you regulate that? Mm-hmm. The Kenyan model I was always told that it is telecom-led model. And John and I have defended this in so many forums. It is not a telecom-led model. It's only that the telecoms invested in very huge capacity. Remember, the East African region is the only region that have come up with an excessive supply of fiber optic cables coming over the that massive capacity had to find itself useful. So the telecoms actually provide the transmission. What happens is that, especially everybody talks about the M-Pesa model. M-Pesa model is a transactions platform in a bank. And it's only that it is minute to one account. Everybody is passing their money through the mobile phone, through the SIM card to the bank. What the telecoms were doing was only providing the function of changing cash into electronic units of cash, and it is loaded into your SIM card and simultaneously loaded to a bank account. And that is how the model started. The second stage was actually provide virtual savings using the same framework. That is, you don't have to move to a bank. You can always do that through your mobile phone. The third one is actually to use the transactions data as well as the savings data to generate credit scores for you for the bank to price credit, microcredit. And in fact, I think Governor Caleb Fudanga had talked to me about that, and they were discussing this in terms of most of the poor are cash strapped. They only require maybe short-term loans which can even last them a week, a month, and that is what has been moving Kenya. And if you can solve that problem, that constraint, then obviously you're going to hook them for life. And finally, we are now having cross-border transactions. Tigo Pesa, Tanzania and Rwanda, for example, Western Union and Kenya and Pesa, for example, and that is international remittances. It is working very well. Okay. All that comes in and say, what about the regulatory aspect? That is where you are.
Yeah, finish.
The regulatory aspect is that it doesn't change the architecture of regulation. Okay. Most countries, like Kenya, started without the National Payments and System Bill or Act. We used the trust law, but that was an intermediary until the law came into place. Yeah. But even when the law came into place, even today, even though we have guidelines that is supporting that, everybody goes to the original trust account, transactions platform, and everything else moves. But the most important thing is that the second stage where you have a virtual savings account, is just like any other banking model. It's just like any other financial services. So, but the regulations don't change. What we really needed was the regulations about the national payments.
Why not by functions?
Yeah?
Functional regulation. Meaning everything that's banking will get regulated by banks.
Yes.
Everything as utility.
Yes.
Yes,
everything. That is what it means. The functional regulations is just there. Thank you.
Thank you. So, Governor, if you agree with the governor, you don't have to say more, but if you can add or amplify briefly.
No, I agree with him 100%.
You do?
As you rightly said, Kenya is the pioneer and they're really experts in this mobile financial services. So, and right as he said, we've been working together as central banks of East Africa to compare notes, to work together to see how we regulate the mobile financial services. So to me, I think we take it as a payment service and we regulate it under the payment service as a payment service provider. Mm-hmm. Like we regulate money transfer companies. When they move into other products, like he's saying, into savings and microcredit, then there they need to be working with a bank that is able to assess credit risk and all that. So otherwise, what we've been doing is to avoid stifle innovation, promote innovation, but also avoid this innovation creating instability within the financial sector. So I think we've been able to provide rules and regulations that these mobile financial services follow. And it's within that context of really making it easy to promote the innovation in this sphere that has brought many people in the financial inclusion network.
Thank you. I think we are running out of time. I have to go to Q&A, but I just want to know if you want to weigh in, Ms. Shaw. Okay. I think then I'm going to open up for questions and answers. Please, in the back, introduce yourself, okay? Please introduce yourself. Basically, your name and your affiliation. No long introduction. Okay?
I'm Aquila Ledbetter, and I'm a graduate student at SIT here in D.C., and I'm a native Washingtonian. I wanted to ask the question about the value chain that you were talking about. Are there any ideas in using maybe African American businesses to train countries who would be susceptible or would welcome value chain businesses in Africa? When you talked about the diaspora, I was just thinking that might be a good tool to kind of empower both ends. Question.
Very good question. Let me take, please.
My name is Covey Wilkins from Development Finance International. We're based in Bethesda. So I was curious about, from the research and the banking perspective, what are some of the most effective ways that the private sector can help influence the adoption of mobile banking and kind of ease the transition over? Because we've been seeing that sometimes, even though mobile banking is a really efficient way to go, and it makes sense from the company's perspective, it's still hard to convince the individual smallholder farmers to adopt it.
Thank you. Yes, all the way.
Hi, my name is Trifat.
Why don't we see you? Just get,
Okay.
Okay.
Hi, my name is Trifat. I'm from American University. My question might be a little bit of the discussion. It seems that there is an understanding that financial inclusion should be the domain of the government and the international development institutions. So my question is, why do you think so? Or is there any evidence throughout the world economic history that financial inclusion, the service provision of financial institution or financial products, should be the domain of the state or the domain of international institution, development institution? Within that, what is the role of the private banks then? And how does the government accommodate this conflicting role of a provider, a promoter of financial inclusion, and at the same time, a regulator of financial institutions?
Thank you. That's just only one question allowed. Okay, so in fact, what's interesting about your question is that it's related to the private sector question as well. So let me take two more questions, please.
Adebola Daramola is my name.
He's
A graduate student from Salisbury Purdue School Business of. It's interesting that startups, fintechs, we're seeing them in Africa contributing to financial inclusion. But recent developments shows that central banks they don't appreciate they don't understand the difference between financial fintechs and conventional banks. So oftentimes they are slamming, restraining them and their growth. I take example from Nigeria and Kenya, the recent remittances. So I would like to take, so that question is posed to the two regulators, which are the Rwanda and Kenya. What is the response? What should be the response to these fintechs, which ordinarily by their stature and nature are not in any way related to conventional financial system?
Okay, one more question, and then we'll go through responses here.
Thank you,
You're going to introduce yourself too.
I have one comment and one footnote.
Okay. Okay.
Okay. No, the comment is that I think that this discussion would gain in focusing more on specific services and specific de-risking needs and options. Because depending on whether one speaks of payments or access to credit or access to insurance, the questions will be very different. And I think not enough time has been spent discussing de-risking. There are instruments of de-risking. The problem is why would we think that people are willing to pay for them? And one of the difficulties, for example, of disseminating crop insurance is to convince the farmers to pay for them. So if the farmer isn't willing to pay, who will pay for the insurance? And I think that's really part of the access to credit. And the reason why I think that it would be very useful to focus more on specific services is that I would like to link with a previous discussion in the previous panel about the role of research. I've been very impressed by a piece of research, which was a book called Portfolio of the Poor, a book published by Jonathan Murdoch and three other co-authors in I think it was in 2009, which was a very, very detailed empirical survey about how poor households were using financial services, and most of them were informal services. So I won't summarize the book, but one very interesting lesson from the book is that it would be a great idea to try to supply services that these households need. And the book was comparing what microfinance was proposing as compared to what they need, and concluding that it was proposing a lot of services that were not corresponding to the needs of the people. So that's something where research could very much help. My footnote is totally different. It's on the macroeconomic comments that you made, and I'm very much in line with you on that. I think I would go even further than that and argue that it might be interesting to define financial inclusion as the access to services that allow to mitigate the macroeconomic risk. Because there are many situations in which the macroeconomic situation there are cycles. So there are many cases in which the macroeconomic situation will not be propitious to using financial services. What distinguishes financially excluded people from financially included people is that the latter have ways to protect themselves against the vagaries of interest rates and inflation.
Okay, so thank you. Yeah. So I think we have 5 questions. I think the last one is the commentaries. All right, Pierre. Yeah. So I think maybe there is a question on African American and value chain, which I thought was very interesting, and there was also a question on the role of the private sector. I think that should be linked with this notion, this conception, or misconception, I don't know, financial inclusion being a domain of governments, donors, and international financial institutions. I think with the idea, where is the private sector? And the other is fintech, which is actually kind of directed to the two regulators. Why don't we stay with these, begin with the first African American value chain. Maybe we should begin with an American.
African American, sure. Why not? I don't think it's exclusive to, say, African Americans. I'll give you, we had a program called the African Diaspora Marketplace, which has run for 3 years, where we really looked for diaspora, writ broad, who had entrepreneurial ideas about creating businesses in their country of origin or their country that they were interested in, and providing them with technical support to be able to build viable business plans, and then actually having those business plans sort of marketed, if you will, to financial institutions. It was not exclusively to African Americans, it was much more broader. And we did not exclude the companies from being in a value chain. Within AI, so so that is to answer, could African Americans be engaged in something like this? And I think the answer obviously is yes. That program, we're rethinking it now, and so it is not available. We're hoping perhaps to relaunch it in a year or so. But in the interim, we are working in value chains. I mean, the way AID operates, we actually have budgets and sectors that we work with in specific countries. Some of them are earmarked by Congress in terms of where our money goes. Some of them are presidential initiatives. Some of them are just the normal strategic programming for the country. Across Africa, there are value chains that are 3 trade hubs, one in Nairobi, one in Accra, one in Southern Africa, are dealing with. So those we're actually putting funding in, we are supporting them. Some of them are to mitigate food security or food insecurity regionally. Some of them are for export, like cashew, shea, pineapple. What I would suggest, if you have a particular skill, business skill, or knowledge of a particular business that would be within a value chain, I would suggest you come to the Diaspora in Development Conference. There's going to, all of the bureaus, including Africa, but also the other regional bureaus, are going to talk about what they're doing with the diaspora. And so you'll get a sense of where there may be opportunities to work with USAID. We do not directly fund businesses generally. We have what we call DCAs. We have the Development Credit Authority, which actually deals with risk, guarantees to banks for particular sectors or for micro, small and medium enterprises. So you'll get a sense of what are some of the sectors that we're working in and some of the mechanisms that we have available. I would start from the market, whether it's a regional market or a local market, or if you're talking about doing export, and then go back and see what's happening along that value chain. And it's not just small businesses. We're also working with very large businesses that are interested in working in the value chains as well.
Thank you very much. Maybe why don't you also proceed responding to the role of the private sector?
In financial inclusion.
Yeah.
I think there is clearly a role. I mean, and I'll let the governors speak to some of the issues about fintech or informal financial sector.
Yeah.
But the financial market is a global market. Ghana is not isolated from the rest of the global financial sector. Rwanda is not isolated from the rest of the global financial sector. And so, as a result, one has to deal with the private sector. The policymakers, the governments, and the private sector. Since the advent of greater violent extremism, there is much more scrutiny globally along how money is moving, not just in the US, but also in the Kenyas of the world. And so there is, and I can't remember the name of it, but there is a global organization that looks at how and what funds are flowing. So that may, to some extent, address perhaps some of the issues with the fintech. But because it is an integrated global financial sector, one has to engage. And as I said before, there's the research of what is needed in the country, or what are some of the sectors that are needed. Clearly, it is the government that will then take that research to determine the types of policies, what one wants to do either in mobile money, et cetera. But it's, as you said, it is the financial institutions that are still sitting there. Even micro-financial institutions will have banking relationships with larger banks. So the private sector has a role to play, and I think it is a dialogue that all of the stakeholders have to engage in.
Thank you. So maybe, Robin, on the private sector.
Yes, absolutely. And I think that the private sector question can also link back to the question of who owns financial inclusion, which I think came up earlier in a sense. And so I suppose the answer to that, at least from the work that we've done, is that financial inclusion is a deeply multi-sectoral space. So the good news is that you can look at the different types of entities that are involved in the financial inclusion ecosystem and consider how best you can leverage the strengths of each of those types of entities. So for example, telecommunications companies are often accustomed to working with customers who are transacting in very small denomination and relatively high frequency types of transactions. They also have immense marketing power and distribution capacity. And then you look at banks and other traditional financial institutions that have these very sophisticated back-end systems for processing transactions. They also have a lot of know-how when it comes to performing know your customer processes and other dimensions of anti-money laundering processes. So when you look at those types of entities and then think about even other types of potential points of financial access, like post offices are one example, then you bring in the trust element when you have points of access that are more local and customers may be more familiar with them. So there's a really positive dimension, I think, to the fact that there are all these different actors in the space that each bring something to the table. So I think the related question then becomes how to regulate in an environment that is increasingly complex. And I'm sure the policymakers in the room could speak to this in much more detail. But for us, I think we found that the question is perhaps less who the particular actor is in the financial inclusion space and more the what and the how of what they do. So what types of financial services are they proposing to provide to the general public? I think that helps inform some of these questions about how do you ensure that they're operating in a space that protects the consumer but also doesn't present any undue barriers to access for those who need to utilize those services.
Thank you, Robin. I think I've been told that I should be ending this in 5 minutes.
Tiny footnote. The other thing we haven't touched upon too much is the diversification of the financial sector. And so we've really just been talking about savings and loans for the most part. But especially as it relates to small farmers, small entrepreneurs, there is really the need to not only deepen access or broaden access, but deepen and diversify that access. And that's leasing, that's factoring. There's a lot of other types of financial services that we need to be bringing to bear to deepen the fabric of the financial sector.
By the way, that's actually a very good point. So we had a senior policy seminar on financial inclusion in Nairobi. This is basically a research meeting policy. And a part of the ownership of the financial inclusion was a resolution which really felt strongly that it could be sort of in the broadest terms. Okay, it's not just access to credit, okay? It could even include derivatives, access to even stock markets. I mean, it's really a whole range of activities. But now we're to the governor, FinTech. And then we're going to be, and then I'll give you 1 minute.
I don't think central banks are stifling fintechs as such. But I think we need to understand that we financial services are regulated because they are linked to individuals putting their money to a third party that they need to be assured of the safety of their money. So if anybody came up and set up a financial institution that starts collecting deposits and issuing credit without any regulatory framework, that's very risky to the stability of the financial sector in general. So I think, yes, we need to understand that technology is developing at high speed, and we've been challenging ourselves as regulators to catch up with this speed. So maybe in some areas there might be fears, and therefore they stick for this. But I think what we try to do is to really move to the level of this development within the financial sector. So I think what we are supposed to be doing as regulators is to enact laws and regulations that govern these operations to ensure stability of the financial sector in general. So otherwise, it would be chaos within the market and it wouldn't help anybody. So I think from our side, we had a discussion recently with other stakeholders, and the challenge was these fintechs need sort of an incubation center to test their products. So they develop products and they want to test it in the market immediately, start engaging individuals using their services. That's a challenge. I think what we are agreeing with our colleagues is to create an environment where they can test their products when they are ready to come on the market. That's when we should come in as regulators, because all as regulators, we are concerned with the stability of the financial sector. So how we balance the support of the innovation and the ensuring stability, I think that's very key. Of course, we have mobile financial services. It's more or less an advanced form of fintech that started in some countries. They completely refused it, but Kenya was bold enough to embrace it and made a big difference. And so we are all enjoying its benefits because Kenya embraced it from the beginning. Just maybe one point on private sector. I don't think there's any claim that financial inclusion is left to government and development partners. No, if anything, private sector like the banks, the mobile financial services we're talking of that has had a big impact on financial inclusion. This is private investment completely. We talk of banking agents within our countries that have transformed small shops into banks. These are bank innovations by financial institutions. So what we have to do as regulators or as policymakers is to facilitate these innovations. So otherwise, I think we come in where private sector would hesitate to come in because it doesn't make business sense. So that gap has to be filled by government and development partners to create an environment that now attracts. At the end of the day, private sector will have to come in if we are to ensure sustainability of whatever we achieve. But there are areas that, by all means, private sector will not be interested because it doesn't make business sense. In that case, government has to come in and the other development partners.
Thank you very much, Governor. 1 minute.
Okay.
Yes. Yeah.
I just follow up what Governor John has said. And that's 2 points I'm going to make. Financial inclusion, this is public policy. And we know what is the objective of public policy. So essentially, we are all participants. The fintech issue, very interesting. But let's focus on regulation, or a regulator is actually providing public good. And so you have to optimize, or should I say, minimize regulatory arbitrage, because essentially then you cannot talk about the stability of the system. And the second thing is that fintechs may be discouraged in some areas just because of regulatory capacities not catching up with the innovations by the fintech. And finally, if you have innovations without any form of tractability, of course, nobody would like to go for that. And then we have seen most of the financial crises have come in because of innovations without the appropriate tractability. And that is why it is not discouraging fintechs. It's actually trying to understand, to be on the safe side. And that is what we really want. So it's not a question, like, for example, you said M-Pesa is one of the most perhaps celebrated fintech product. It's a product. But you can see that it is working within very, very agreeable and appropriate safeguards, tractability and otherwise. And you can see that's why it has evolved to become one of the, should I say, movers of what financial inclusion is all about. That's what I wanted to.
Thank you. That was very nice. So I think that we are going to come to closure. I think I'm going to turn this to Peter, and I'm going to do that in the context of research, okay? And one thing that you may not know is, maybe which is underappreciated, is that this whole policy dialogue is inspired by the support that USAID has provided to GDN and ARC on financial inclusion, on aid effectiveness. And that same research on financial inclusion through the ARC network was actually brought to the senior policy seminar in Nairobi in March 20. And what I would like to say is that in the context of Africa, there are so many research gaps. One thing that you need to appreciate is that if you look at the financial inclusion development gap and financial development gap that Africa faces, the gap is not just relative to more advanced economies. It's also relative to other peer low-income countries. And so we have issues on linkage between financial inclusion, inclusive growth, design features of risk, design features of securities, risk mitigation securities. So there's a whole host of issues. And by the way, this is also a new territory for ARC. In fact, I'm actually the first financial economist hired to be in that position. So we're actually taking this very seriously. And luckily, recently, to actually scale this thing up, we competed on this global bid for low-income finance, which is spearheaded by the United Kingdom and ESRC. And the Africa group, inclusive of ARC and Brookings, end up winning this. And so we have now pretty extensive, we have just begun pretty extensive, comprehensive research on finance to take what we started with USAID to the next level. And then maybe Peter is actually here as one of the research participants from ARC. He might actually weigh in this just with 1 minute, and we're going to close.
Oh, okay.
Okay?
I have the last laugh. Yes.
Yeah.
So basically, the private sector, I just want to comment on the private sector and research. Yes, they make a lot of investment when it comes to financial inclusion, as the governor has said. But when it comes to research, that is where you also see them participating. Sometimes they don't fund research, but they participate in terms of the data collection, in terms of the processes. So the private sector is not absent completely. They are part of the whole process. Let me mention to the chair that I happen to be one of the people who evaluated the ARC proposal, the ESRC defeat proposal. So I know what is in there. In it, you will see a complete linkage with the private sector so that all the processes, the research activities and the rest is going to involve financial institutions in the data collection, in the formulation, and so many other things. So we see active participation of the private sector in research, and the ARC bid is one clear example where we can point out to.
Okay, thank you very much. So it's been a real pleasure to chair this, and also, by the way, thanks for ARC partnership with GDM, Brookings, and the support of USAID, really helping us to bring Africa voices, is that right, to Washington. And we'll also take the Washington voices to Africa. It's be a two-way. Thank you. Okay, show of hands. Okay? Yep.